All right, I'm caffeinated and excited because today we're going to be diving into what I think is the easiest commercial real estate asset for anyone to own. Whether you are a beginner or you're an advanced investor, flex space is basically the equivalent of 5 plexes in multifamily.
But Hamza, tell us what flex space is, because I know that there's some confusion out there as to what it is and sometimes isn't.
I would say an easy entry for any beginner. Think about a single-story, single-family home. I would compare flex space equivalent to that in the world of commercial real estate. What flex space allows you to do is it basically allows you to build these small metal buildings, and you can have multiple tenants within one building. There is a huge demand right now, and we just can't keep up.
I'm going to do something that I haven't seen anyone else do on YouTube, and we're going to actually dive into every single aspect of the deal and break down the numbers from land acquisition to rental rates so that you can go out there and confidently build or buy one of these assets yourself.
What kind of tenant base do you typically find in flex space?
Most people, I think, get intimidated and think these are industrial manufacturing guys who, are coming in and doing heavy lifting, and it's really not the case. Pickleball is probably now the #1 most desired tenant to have in a flex space because all they're really looking for is empty space. Last year, or the year before rather, it was podcast studios. We've seen daycares, we've seen boxing gyms, CrossFit gyms, we have swimming pool companies, lawnmower repair facilities.
Anything that might need a little bit of warehouse or wide open space in addition to their offices, and may or may not have loading docks, but probably do have larger roll-up doors so that businesses can move product in and out depending on their needs. And you probably guessed that it is very creatively named because of how flexible the uses are within this asset.
Talk to us about the vacancy and demand rates for this type of product.
I like to see them being built in high growth corridors, meaning brand new neighborhoods where land is abundant and still relatively inexpensive so that the numbers work and the deal makes sense, right?
Now, one thing that you may or may not know is that flex space is actually one of the most in-demand commercial real estate products out there. Aside from affordable housing, vacancy rates in flex space are unbelievably low. In fact, they're probably at historic lows today. And that's because we cannot build flex space fast enough to accommodate the tenants that are taking them.
How do you make the numbers work on a flex space deal? Like when you say, we're looking for cheaper land, what does that mean to you?
To make it very simple, criteria is extremely simple, right? Land needs to be below $5 a square foot. You need to have at least an acre for the numbers to work. So 1 acre below $5 a foot. And then you need to build at least 10,000 square feet. Anything more than that is, I would say, just added value that you are going to benefit off of.
But let's get into the numbers of this deal. I'm going to break it down from a build and development perspective. If you want to skip ahead to buying these assets in as-is condition, check out the timestamp at the bottom of the screen. But I will say, there is far more money to be made on the construction side if you're going to go develop these yourselves. And it's really not as difficult as most people think it is. So if you're looking at developing your own assets in the flex warehouse world, the first place you're going to look is for land that is actually affordable to where you can build this asset and make it profitable. So we know that our land is going to cost about $5 a square foot, but what about construction costs? Well, just like every other property type in real estate, construction costs have gone way up on flex space. But the good thing is it's still cheaper than most other types of commercial real estate out there because you're not having to finish it quite to the level that you would, say, a hotel or an apartment complex. You can expect to spend anywhere from $85 to $125 a square foot on the site development and building costs. So your horizontal, which is the ground, and your vertical, which is your structure. So if we take our $5 per square foot for the land and we attribute 100% of that to the 10,000 square foot building, plus our build costs, that gives us $136 a square foot for our build costs. $136 is just an example. You could do it way cheaper. It could also be far more expensive. But in my experience, $136 a square foot is fairly conservative. So chances are pretty good that you'll be able to come in under that build cost. So to break that down a little bit further for those of you that may not know how to run numbers on dollars per square foot per acre, $5 per square foot per acre is about $240,000 an acre. There's 43,560 square feet in an acre, so just multiply the two, and that'll give you the number. Finding land at that price is not really gonna be feasible within the urban core of any market. But that's the beauty of flex space. You don't have to be immediately downtown in order to make these deals work. A lot of these companies just want to be located on high traffic corridors near interstates so that they are easily accessible. And the benefits of that is they don't have to deal with traffic when going to work. So if $240,000 an acre for a 10,000 square foot building works, but you might be able to build more, imagine how much better those numbers will look if you can build 15 or 20,000 square feet. So let's say that you're able to build 20,000 square feet, but don't necessarily have the cash to do it today, or you don't want to raise that capital from investors. Just plan it in 2 phases. Build the first 10,000 square foot building, lease it up, pull all of the cash out through a refinance, and build your second building.
This is a typical 2x return or 2x multiple exit for you, right? So if you put $100,000 in, you're going to get $100,000 out.
So it's very easy to run numbers on an existing asset and what your potential exit will be, but what kind of cap rate should you assume when you're building commercial properties? Well, it really comes down to the yield that you need to get on your property. Typically what I recommend is an 8% to 9% cap rate upon completion and fully leased up. That gives you enough spread to cash flow if you need to keep it, but you'll probably be able to sell it for a 7% cap rate, which means you're going to capture the delta there in your profits. So let's break that down a little bit. If you're building a 10,000 square foot building at an all-in cost of $136 a square foot, you're going to be at $1.36 million total cost. Now, if I'm going to rent it at an 8% cap rate, I'm going to be renting it at about $108,800 per year on a triple net basis. Now, if I sell that income at a 7% cap rate, so just dividing $108,000 by 7%, that's going to give me an exit price of $1,554,000. So the delta between those two is just under $200,000, not including any real estate commissions or fees or closing costs if you're going to have to pay that. So let's break down what the returns would look like in this case. Now, my underwriting is a little bit more conservative than Hamza's, but let's assume you put 25% down on the 1.36 million, which is $340,000, and you've profited $194,000, which gives you a 57% return in probably about 2 years. At over 25% a year, that is almost twice the value that you could get out of the stock market, and anything better than you could get in multifamily today, considering how high interest rates are and how low the cap rates are in multifamily. Now, if you're wondering how we got to the $108,800, yes, it was an 8% cap rate, but you're going to assume about $16 to $18 a square foot triple net on the leasing rates, depending on your market. Maybe a little bit less, could be a little bit higher if you're in an area like Nashville, but that's a pretty good estimate for you to use when you're putting together your initial underwriting.
When I was starting off, obviously, there's 2 schools of thought. One of them is cash flow, and the other one is a refi. So you refi out, you get a little bit of equity in. I actually created a whole new school of thought, which is sell the whole thing entirely, just because the demand, like I said, is so high. If you think about it, right, every deal that you sell, and let's say you're making a 2x return minimum, right? Every deal that you sell allows you now to do 2 deals. And if you follow that path, if you follow that journey 8 years down the line, on a refi scenario, you would do, let's say, 3 refis over 10 years or 8 years, whatever it is, versus every deal gives you 2 deals. You end up with like 8 deals at the end of 8 years versus just 3.
So once you're looking to sell this asset, 7% cap rates are a pretty realistic exit considering today's interest rate environment and market conditions. Now, depending on where you are located, it could be a little bit lower, it could be a little bit higher, but when I'm running my underwriting, I like to assume that we're gonna be in the middle of the road, right? So 7% is probably what you should underwrite and expect to hit as you're exiting these assets. Now, if you're buying these assets, you'll want to make sure that there is some room for value add, right? Because you can't really afford to pay a 7% cap rate with interest rates at 7 to 8%, and expect to make any spread unless you're planning on paying all cash. Now, that value add could be from filling up new tenants, raising rental rates, and more of your operational side of things, or it could be adding another building to the property and leasing that up as well. The good thing is that a lot of your due diligence on flex warehousing should be fairly simple if the product is newer, because a lot of landlords are going to a triple net style lease, meaning the tenants are responsible for their share of the common area maintenance, the property taxes, and the building insurance. So if you're coming from multifamily into flex warehousing, you don't have to worry about your insurance rates going up like they have over the past year. You don't have to worry if the property tax taxes go up. Those costs get passed directly through to the tenants. So your base rent is what you are going to collect and what you can count on for the next 3 to 5 to 10 years, depending on how long your leases are.
What do people often get wrong about flex space?
As an investor, what people often get wrong is they get intimidated by the fact that it is commercial real estate and they think it must be difficult to get into. So I'm going to go ahead and buy 4 more houses and deal with 4 more tenants and 4 more roofs and 4 more HVACs. And I think that is where they get everything wrong, which is why I took it upon myself, to start social media, get on YouTube, get on TikTok, get on Instagram, and talk about all of these things and show people that, look, these are my tenants. I actually go and have a conversation with them, and this is the business that they do it with. And believe it or not, I think I've changed quite a few minds, as have you. And I think we'll continue to do that, man, as we progress.
Now, having gone into all of that with Hamza today, I think that flex space is by far the easiest commercial real estate investment to own. Let me know what you think in the comments below. And if you want to learn more about development so you can do these projects on your own, check out this video here.